We know exactly what SpaceX builds. They launch more rockets than entire nations, run defense contracts that run deep, and operate production lines that look like they belong in the next century. Starlink alone connects over 10 million customers across 150 countries. Buying shares on day one feels like securing your stake in a massive global monopoly. But getting that access right now comes with a severe cost. You're paying a price built on brand excitement, detached from the actual math of the business. The bankers who structured this deal built it to use ordinary retail buyers as exit liquidity for the early investors. Everyone on financial media is celebrating the opening price, but the actual risk lives inside a 150-page public prospectus filed with the SEC, a document almost no one buying today has bothered to read. If you want to know how to spot these hidden mechanics before you put your money on the line, subscribe to Inside Anchor. We read the fine print so you don't have to. Buying into a break company while ignoring the legal framework of the deal turns an investment into a highly engineered gamble. This chart shows exactly what you are paying for. SpaceX is entering the market valued at $1.75 trillion, compared to last year's revenue of about $18.7 billion. You are paying $94 for every single dollar of sales for a company currently losing money. When independent researchers ran the math, they priced the company closer to $780 billion. The public price requires the company's future to be flawless just to break even on the valuation. We have seen a clear pattern with highly valued tech stocks. They experience brutal sell-offs the very moment the initial lockup period expires and insiders get permission to sell. Look at Palantir. Retail enthusiasm drove the price up early, but the day insiders cashed out, the stock dropped 13% in one session. Rivian buyers faced a similar reality. 6 months after a publicized opening, early investors disclosed sales, and the stock plummeted 20% in one day. Uber's expiration date pushed the price down to an all-time low on the exact day those trading restrictions lifted. Buying at a peak premium means your capital sits directly in the crosshairs of early investors looking to lock in their profits. Standard IPOs use a 180-day lockup. They freeze insider shares for 6 months to prevent the entire supply from crashing the price on day one. This chart shows a custom clause buried in SpaceX filings, a performance trigger. If the stock hits $175.50 early, it breaks the lockup open, closing 30% above the IPO price for 5 of 10 days, releases 10% of insider shares immediately. The futures market already priced the stock near that level before trading started. A strong first week functions as a starting gun for early selling. To make sure the price hits that trigger quickly, the company only released about 5% of its total shares to the public today. By starving the market of supply, they practically guarantee a price spike. A new rule takes this further. Because the float is so small, the Nasdaq index treats that 5% as if it were 3 times larger. That inflated weight forces hundreds of billions of dollars in passive index funds to mechanically buy the stock, regardless of the valuation. All of this institutional cash is forced to flood in right as that early performance trigger fires and insiders get their first chance to sell. The deal structure uses index rules and low supply constraints to manufacture the exact liquidity insiders need to cash out at the absolute peak. To survive this highly engineered setup, you need to step back and track exactly what happens over the next 6 months. Between late August and October, SpaceX unleashes 5 staggered tranches. Another 7% unlocks every few weeks, trickling 35% of insider supply into the market. 2 massive cliffs tied to Q2 and Q3 earnings land right in between, hitting when most retail buyers aren't looking. This staggered structure creates a gauntlet of overlapping triggers that subjects you to a slow, continuous bleed of dilution. Add up the performance triggers, the staggered dates, and the earnings cliffs. By the time the 18-day mark arrives, 83% of all insider shares will have been released. Holding through this period means forcing your capital to absorb wave after wave of intense, invisible selling pressure. Let the calendar hit December 9th. By day 180, the final 17% restriction lifts, passive funds are done buying, and 2 quarters of audited reality are on the public record. Headlines will praise the founder for holding his shares, But top executives operate on different rules than venture firms and early employees. Elon Musk is locked out from selling for a full year. This projects stability to public while providing a massive umbrella for early insiders directly beneath him to cash out early. Patience is the most effective tool you have. Let the calendar do the hard work of stripping away the hype and fully pricing in the actual supply of shares. You get to acquire the exact same underlying business, but at a price anchored to audited performance instead of a manufactured countdown clock. True wealth logic requires stepping back from the noise. You win by letting engineered deal mechanics expire, not by rushing to be the first one through the door.